In 2025, I started a new portfolio where I invest $1,000 every month into a new stock. The goal is to use all the tools that I have built at Dividend Stocks Rock to build a portfolio up to $100,000 by the end of 2031. So today we're going to take a look at where are we today with this portfolio, and I'm going to tell you the stock that I will be adding in November. It's a company that shows a total return over 500% in the past 3 years. And I think there's still more room for growth. All right, so let's get started to where I'm at with this portfolio so far. So I almost show $9,000 in worth, and my goal is to reach $100,000 by investing $1,000 at an annualized growth rate of 6.5. So I go relatively conservative, knowing that investing in the stock market should generate between 9 to 10% over a very long period of time, but we don't know if we hit a bear market in 2 years from now. It's going to be rough to reach a higher than 6.5% return. The portfolio is now including 8 different companies in 6 different sectors. So I wanted to show you as well how you can build a diversified portfolio across different industries, even if you're starting with a small amount every single month. The story so far is really a matter of great performance for 3 companies: Stentec, Franco-Nevada, and National Bank. So those are the one pushing my portfolio up. I'm showing about a total return of 10% this year so far. So not that impressive if you compare to the TSX, but my exposure to gold, notably, is only to Franco-Nevada. So I could have done a lot better if I invested a little bit more into natural resources. I have some lagging stocks, of course. So the 5 other companies in my portfolio are Canadian Natural Resources. I just added in October, so I'm not necessarily expecting this one to drive the portfolio up. I added also 2 defense play with Dollarama and Waste Connection. I recently discussed Waste Connection on the Moose on the Loose for its poor performance, so you can listen to that show on the YouTube channel as well. And then I complete the portfolio with TMX Group, a stock exchange owning the TSX, and finally CGI, which is my biggest loser so far. There's a lot of fear around AI and also around the fact that the company could lose contracts in the US if the commercial war keeps on going. And right now it's on fire. The goal of building this portfolio is not just to reach $100,000, but also to fund a part of my retirement. If you are about to retire, I do have a webinar in a few weeks about 6 retirement upgrades you can make to make your life easier and smoother at retirement. So that is for all Canadians that are 5 years before to 5 years in retirement. So a lot of important decisions can be made during that 10-year period, and I'm going to discuss them into this webinar. You can register for free at retirementloop.ca/webinar. The link is in the description below. All right, so now let's get on with this famous stock that went up by more than 500% in the past 3 years, and I still believe it should belong in my portfolio, so that's going to be my buy for November. So TerraVest Industries, TVK, trading on the TSX, of course, is a manufacturer of home heating product, and it also builds and sells propane and natural gas liquid transportation vehicles and storage vessels. So think of like those propane tanks. 2/3 of its business is in the US and the rest is in Canada. TVK sales for the past 9 months shows a great concentration in compressed gas equipment. So 43% of their sales are coming from that segment. The HVAC, the home heating product, is 31%. Then you have processing equipment at 8%. And then a really interesting one is the service segment at 18%. Why I find it so interesting is because once you have sold and installed the tank, well, you get back to provide maintenance services. So it's a recurring source of revenue that should help TerraVest to smoother growth going forward. So the investment thesis here, it's quite simple. I mean, the playbook for TerraVest is manufacturing and selling specialized equipment tailored for niche markets. So they will help various industries such as mining, agriculture, construction, infrastructure, and they sell critical parts for their business. I mean, if a company needs natural gas to run their operation, they will definitely be willing to pay the price. The company has two great growth vectors. The first one is they have been growing through several acquisitions in the past. They operate in a highly fragmented market, so they can buy smaller competitors and then do cross-selling. So they can expand their product offering, they expand their book of client, and then they can do that cross-selling. So that's the first growth vector, and you will see in a second when we're going to take a look at the dividend triangle how fast the revenue has grown over the past 5 years. The second growth vector I see here on top of the high demand for HVAC products and natural gas storage tanks is also the maintenance aspect. As I said before, the company offers services and maintenance, which is now almost 20% of their business. In terms of economic moat, I mean, they focus on niche markets, so they know a little bit more. They build close relationship with their clients, but I don't think they have a very solid moat here. Yes, it is an interesting competitive advantage, but any other companies with a lot of cash flow could come and to become a serious competitors in those markets. Now, let's take a look at how this narrative translates into numbers. To make my analysis, I always refer to the dividend triangle, which is a combination of revenue, earnings per share, and dividend growth trend. The idea is to select companies that have the ability to grow their sales and then increase their profits so they can share the wealth with shareholders through dividend increases. The dividend triangle for TerraVest looks quite nice. As you can see, the revenue keeps on going up very, very fast, thanks to a lot of growth by acquisition. On the other end, though, when you take a look at how the earnings per share trend is going, it will go through bumps and then it's going to take some pauses. The reason is quite simple. At one point, you have to issue more shares, get into more debt, pay higher interest rates, and then you also have to integrate what you just acquired. So from time to time, you will have a pause in the earnings per share growth, which is actually happening right now. And that is explaining the recent stock drop where the company started very strong at the beginning of 25 and then they saw their price going back down after their most recent quarterly earnings. That will lead us actually to the risk section. So unfortunately, nothing is perfect, and TerraVest Industries, as much as it is an exciting company, it brings a lot of risks with their growth by acquisition strategy. A good example was in 2025 Q3, where revenue surged by 70%, but higher financing costs, amortization, integration costs has hurt the earnings. It's a small cap. Rapidly, the stock price fell. If you think of buying shares of TerraVest Industries, I must highlight this risk because it's obvious, yet a lot of investors tend to just think about the growth potential for small caps, but it could also go the other way around. Meaning that you could buy TerraVest Industries and it could go down in 20% within the next 2 months without any warning. So you have to be very careful and to be able to stomach those kind of fluctuation. In terms of other risks that I can see on this one, well, of course, if there's an economic downturn, if companies go through a slowdown in their investment cycle, they will not tend to renew their storage tank or their HVAC equipment. That will also lead to a slowdown in growth. And of course, it's going to be a little bit harder for the company to make great acquisition and propel the stock to a higher price. So to wrap this up, I'm going to add $1,000 in TerraVest Industries in November. I'm well aware that the stock price skyrocketed over the past few years, but I think there's still more growth because it operates in a highly fragmented market. The growth by acquisition strategy works really well, and there's still plenty of growth both in Canada and the US for the future. I've found this company using the Rockstar list. It is a long list of about 300 stocks that shows a positive dividend triangle. So any company showing positive revenue growth, earnings per share growth, and dividend growth over the past 5 years will be in this list. You can download it for free at dividendstocksrock.com/rockstar. The link will be in the description below as well. And once you subscribe to the newsletter, every month you're going to receive the updated list. If you are a DSR member, it's even easier for you because the list is already saved in your stock screener and you can modify it, add up to 50 financial metrics, and tailor it to your exact needs. All right, guys, that's enough for today. I hope that you have enjoyed this video. Let me know what you think of TerraVest Industries in the comment below, and we're going to talk again next week. Until then, don't forget to stay invested.